In today's market episode with Samantha Cozza-Wright and Dan Gerhold, we are breaking down the cattle markets. Everything that Dan and Samantha have been seeing over the past week, some indicators as we go into the remainder of fall, start out winter, and into 2026. January is right around the corner, and so we start discussing all of those things as well. In today's episode, we are breaking down everything that you could possibly need to know about the cattle markets. Before we hop into today's episode, if you could take a second to subscribe, rate, and review this episode, we would really appreciate it here at the team. Without further ado, let's go ahead and hear from Samantha and Dan. Dan, Samantha, welcome back to the podcast. What is going on in the world of the markets? Who would like to take the first swing at it this morning?
Samantha.
All right. Well, we saw live sales last week on the negotiated fed cattle trade range from 228, 237. Weighted average kind of settled at 230.45. So Southern Plains was definitely trading at a premium to the Northern Plains, but just didn't have the volume to drag up that weighted average. CME feeder cattle index was down hard last week. I think if we keep seeing green on the futures board and the auction barns hold steady, we'll hopefully see cash go higher towards midweek to the late week.
Dan, what are your thoughts?
I agree. It's kind of amazing how everything flipped. Last Monday, Tuesday, everybody was doing doom and gloom. We were going to zero, and then by Friday, there was 8 weights selling at record high prices out west again. So it's pretty funny how fast we're willing to get bullish after how quick we got bearish there. It was pretty incredible as far as the cash market was concerned. Futures, a lot of obviously, we talked about it. A lot of damage got done to the charts. You had 4 gaps put on the charts on the way down. So a gap is just a look on the chart. If yesterday's low was, let's just say, 360, and the following day you open up at 355, there's a $5 gap on that chart. If you don't go back up and look towards that 360, you leave a gap. Those gaps are just an indicator as far as technical is concerned that, hey, we might go back up, revisit that level, hopefully fill the gap and continue back higher again. But inevitably, with what happened, 4 gaps becomes hard to fill all 4 of them. So feeders specifically, that very top gap, looking in January, we don't even touch it until we hit 930. That's a big ask to get back up to those levels. The next one below that is right in that 355 area, and then that we filled the first one, of course, right after, I believe it was Wednesday, we filled that first gap. But the next one we've struggled so far to fill starts all the way up at 340.5. So that is a big gap. I would like to see us fill it. I don't want to see us run up here, touch it 3 times like we have, and inevitably not fill it. That's a very, very poor look. As far as live cattle technical, same thing, except you only have 3 gaps in the February and April and deferred contracts. December actually never gapped lower, mostly because cash was not dropping as fast as futures were during that, bloodbath. So December never gapped. We don't have to worry about that there. There's quite a bit of consolidation on the December daily chart right at our current levels. I don't like that consolidation after a big sell-off because it places a bear flag on these charts. Inevitably, it's not my favorite indicator, but it's there and traders are watching it. So you've seen a market go sideways the last 5-6 trading days, and we can't get any real power to buy this thing and push it back up towards those old highs. We can't get any major selling pressure to sell it off because we're already trading in that low 230s right with cash. It's just a market that doesn't know where it wants to go. And if we look at open interest, which I always like to bring up because that tells us who's trading it and how. You've seen open interest was dropping big time towards the end of that sell-off, and then those first 2 days we rallied, we lost open interest as well. Well, that's not good. That's your classic dead cat bounce. Short traders taking profit. And then since then, we've actually put a little open interest back on the last several days. And in a sideways market, it basically tells you nothing. So I'm glad we're talking about it. It doesn't do any good. But long story short is we still don't know what managed money's doing because the government shut down. I would like to see where they're sitting at position-wise, but inevitably we need cash to give these traders the confidence to go long again with power. if we don't see cash turn the corner this week, we've got some big problems. I was in the camp Friday that we had the potential and had the power to go steady this week, higher this week. Now looking at it and watching the board trade, I almost wonder if we're just going to be more of a steady-ish market. That 234 to 236, maybe in the south. They've got the power in the south to push us up higher. But like Samantha said, there's not a lot of volume that trades in the cash market down there, so that's a struggle. The north was disappointing last week. The very few that traded were, I guess you would call them 6 to 8 lower than the prior week at that 230. That's not good. We need the north to really step up their game here and force this thing higher. So I'd like to see that Nebraska do the work because they're the ones that have the opportunity. Texas, Kansas came up, cleaned up some of those fat calves here a month ago. Iowa, on the other hand, has a lot of big, heavy cattle that we backed up, during that August, September, and early October time period. Until we get those fats cleaned up in Iowa can't be the leader. So I think the ball's in Nebraska's court to force the northern cash higher this week. We really need like I say, we really need it to go. If we're going to take 230 with the board trading at 231, we're back to our negative basis. There's not many producers that are enjoying that. So hopefully they step up. I'd like to see some 230, maybe 234 trade in the north, probably get the south at 236, 237 if that happens. But inevitably, I guess I'd more think we're probably trending towards that steady cash.
Samantha, do you have any other thoughts on what Dan just discussed?
Yeah, I think it's really crazy to see how cash has fluctuated just in the past few weeks. I mean, we were seeing on the feeder cattle market, we were seeing $40 off the high. And that's just, last year, 2 years ago, that would have been unheard of for it to fluctuate to that magnitude. I think it'll be interesting to see what the south border and talks of it opening, towards the first of the year, what that'll have an effect on our markets, if it will, if it won't. I think it's still a little premature. I've heard talk, the sterile screwworm facility south of the border is still only 30% complete. I think we need to get some of these facilities more moving further along before we can talk about opening the border. If you do open it prematurely, that's going to threaten our domestic herd even more than what we're at. So I think that's something we need to look at. So that's kind of my thoughts on that.
Yeah, it's definitely going to be interesting to see how that affects the market in the coming months and into the new year. And even just the talk of it affects the markets. I think that that's kind of the trend that we've been seeing over the past few weeks is how they talk of certain things has been affecting the markets. Not necessarily the outcome of those events affecting the markets, but just the discussion of them even happening. So it'll be very interesting to see how that continues to develop and just shape as we go into December and into January as well.
Yes, for sure.
Dan, your thoughts?
I'd like to combine something with Samantha. She said, that's the talk of the border opening, that's a big deal. And I think that's all eyes are on that right now when it comes to trading futures. Let's combine that with the technical things we just talked about, those three to four gaps we had. You combine that, if we don't fill all of those gaps and they open that border up, there's potential, May, August to October feeders next year to be well under the $300 mark. So to me, if I'm a producer and I want to combine a little bit of technical knowledge with that possibility that we're going to have more available feeders next year if they leave that open, I'd be stepping out and covering next year's, this coming calf crop. What are we selling next summer, next fall? It's long story short, we had short supply brought to you partly because of that Mexican border shutdown. So you bring 1.2 or 3, 4 million head in next year, all of a sudden your supply is not quite as short. Are we going to maintain that $300 feeder mark? I think that's really a good enough reason combined with those technicals. Are we going to get managed money to push us new all-time highs with those gaps and that technical damage done? Yeah. If they're watching the fundamental side and that border as well, I think it's a big struggle to hold this 320, 330 mark out into next year. So it's a big deal. And none of us are in that meeting tomorrow with Rollins in Mexico. And, we don't have an exact date. Yes, Rollins is concerned and doesn't want to open the border, but the fact is it's going to open someday. We just don't know when the date. So we should be prepared and don't sit around and wait for them to announce when it's going to open. because that's when the market's going to correct before you can actually do anything.
That's just it. I think we need to be, as producers, looking further ahead, because when it crashes, I mean, you've seen the last few weeks, it crashes hard. So have that protection on there as soon as you can get it.
Yeah, absolutely. It's kind of one of those instances of being proactive where we can. Not everything in the cattle industry is a scenario or situation where we have that opportunity to be proactive, but the writing is on the wall for this scenario. This is something that we have been talking about for a long time. And like you said, Dan, it's not a question of if, it's a question of when. And so is it going to happen in January? Are they going to wait until the spring? We don't know. That's not something that we know the answer to at this moment, but it is still one of those situations that we can't wait until it does, because then it's going to be too late. It's like you said, Samantha, being proactive, looking forward, and how we can continue to mitigate that risk where we can.
Yes. I think another thing we're seeing in the media right now, USDA came out with a plan last week to fortify the American beef industry, cattle industry. They came out with a lot of good thoughts. So I think when we're seeing a spotlight on the cattle industry, like the Argentina thing posed to the media, Trump coming out with his comments, whatever, I think it did actually, in the end, pose possibly a more positive spotlight onto the cattle industry as far as what we need to fix. They came out, talked about opening up grazing access on federal lands, better access to capitals for producers trying to get their foot in the door. You know, after we saw box beef cutout values skyrocket the last few weeks, while prices at the producer level were plummeting, I think it opened up the government's eyes from that standpoint as far as, okay, there's really no direct correlation between beef at the consumer level and prices at the producer level from a live standpoint. So I think we need to step back and kind of reevaluate this. But going into that, you know, less restrictions for local processors, open up grants for small processors, low interest rates loans to offset startup costs for small processors, and overall just more transparency in the beef industry. I think if we can get the wheels in motion on that, it's all going to be very positive things for the American cattle rancher.
Dan, your thoughts?
I agree. Yeah, I'm glad they're working on these topics. I mean, it's been something that has needed to been talked about, 10 years ago, and here we are. So, let's just hope the government does screw it up. Yeah, it is good they're talking about it. Inevitably, you've got a government that wants to make our cattle herd more resilient, longer term better. So that's good. The devil's in the details for me, though. I never believe it till I see it. So I'm optimistic. I think it is in the spotlight enough if we get the right people, surrounding Rollins, if we get the right people surrounding Trump and the rest of Congress, that'd be a good thing. We'll just see how it all shakes out.
Yes, absolutely. I think that I follow your sentiment there as well, Dan. We'll see how it all shakes out. I'm kind of more on the side of the cattle industry that the less government intervention, the better on certain situations and scenarios. But I think everything that they put in this plan that they are rolling out has the potential possibility to be really great for our cattle herds, for what we've been asking for a while. These are not any new topics that are in there. These are topics that we've been discussing within the cattle industry for a long time, that, hey, if we want to continue to be as self-reliant as we possibly can within the United States cattle industry, these are our asks. These are what we need to continue to develop and grow that where we can.
Great.
Any other thoughts on the markets? Any other highs, lows that we're seeing this week? How's everything kind of outside of the feeder cattle market? I know that's what we've been talking about quite a bit, but is there anything else outside of that market that we need to discuss?
Been getting hammered. Not surprising. Managed money went to a new all-time record long, decided they were going to take their ball and go home. Since then, February hogs went from 92 down. Our lowest trade today was 81. So, you take $10 out of a hog market, that's a big deal to a hog producer. A lot of these hogs are now getting bought at break-even levels as we start to look into spring and summer. So that's concerning. I hope we turn the corner here and get this chart looking higher. Inevitably, the cutout's been relatively stable right here around 100. I want to, once again, we don't have the export numbers with the government shutdown, but my hope is, we've had good load counts on that side of things. You're coming into that holiday demand. Hopefully the hams prop us up if some of these consumers cannot afford to buy prime rib. if we can turn this hammer around and start pushing that thing higher, hopefully, maybe we see that 105, 110 cutout come back. I'd love to see that for these producers, give them an opportunity to get hedged up. There's been a lot of talk around the hogs, this big hole coming in December because of disease pressure, and everybody's been sitting and waiting, buy the rumor, sell the fact. So we bought that rumor, all the way from back this summer when we saw that disease pressure, ran that market up to those highs in the 90s. Now here we are, so I'd like to see the proof, see those kill numbers drop back and weights come down at the same time to prove that holds there. This summer we knew there was a hole. We thought it was in May, June. It turned out to be June, July. So I'd like to see that hole start opening up, as we get towards the end of November and prove that it's in December hogs. But if cash hogs rally, if the cutout stabilizes, hopefully 105, 110 here in December, use that as an opportunity to get next summer's hogs hedged up, because I haven't heard of a lot of disease pressure lately. So I'm very, very concerned we're going to see an increase in numbers. At the same time, I believe I was reading something somewhere that China's actually going to downsize their hog herd. So it's hard for me to believe that's going to happen, and they're going to come over here and buy a bunch of our pork. So thankfully, we've got Mexico. They've been buying a lot of pork over the last year. They've been holding us together. So, and there's other countries. The spotlight is always on China, and I get so tired of it. It's a big country, a huge population. So, of course, we want to sell our products into them. But at the same time, it's a big globe, big world. We could sell to others. So hopefully we make that happen. And if we ever get this government report, government back open, we can see those reports and prove that we can sell to other countries. So as far as grains go, back to that big China word. So China bought some beans, basis is firming, futures made a rally, everybody's optimistic in the grains. Caution to everybody, it's a great big game of chicken between Trump and President yeah. So we don't know who's going to back out first or tweet something. Use these rallies to get some sales on. Don't leave those bins locked until next summer, because there'll be a whole new crop coming next year. Use these rallies and get some pricing in place. So other than that, that's kind of been the markets lately. I guess let's not forget the stepbrother wheat. So wheat made a nice, impressive run. Once again, they're not great levels in this $5.50 range. On Kansas City wheat. Chicago's sitting here. Same thing, 550, 560. It doesn't seem like it's great, but how about next December at 603? Using that. So I like getting started on these rallies. I'd like to see another 20, 30 cent rally, and then I'd be very, very aggressive.
Absolutely. Samantha, any closing thoughts from you?
To shift the focus a little bit, I will mention, but in regards to risk protection, PRF, the deadline on that is coming up here in about a month. December 1 is the deadline. If you guys aren't familiar with PRF, it stands for Pasture Rangeland and Forage Protection. Awesome asset to producers, I will say. A lot of people have a common misconception that this is drought insurance, and I want to make it very clear this is rain index insurance. You do not have to be in a drought for this to work in your favor. It settles off the average rain index in your 17-mile by 17-mile grid. So very positive product. I think if you go back and look at the historic loss ratios, they are extremely high. And I think it has a better indemnity rate, a better historic loss ratio than any insurance product on the market. So definitely something to be looking at. If that's something you're interested in, you don't want to wait, because it can be a little bit of a process just as far as gathering 578s and getting the application in. So just keep that in mind.
Yeah. And we are not seeing super positive reports going out into next year as far as the weather goes. As far as drought mitigation goes, we're seeing a lot of reports start to come out saying that we're not necessarily going to see a bunch of shrinking drought spaces, but we're going to see growth in those areas. It's still early for a lot of that prediction to be coming out, but definitely, like you said, Samantha, one of those things to not wait on. And it's a great tool to utilize if it is necessary for you in your operation. Any other closing thoughts from either of you as we round out the podcast today?
Thanks.
Okay, awesome. Well, thank you both for your insight and just thoughts on this crazy cattle market that we are seeing right now, and just the absolute whiplash that it is to be a part of the cattle industry right now. Thank you both for breaking it down, showing what you guys are seeing on both of your sides. To all of our listeners out there, if you are interested in anything that we talked about today, make sure that you check out the show notes down below and get in contact with our team, and we would be more than happy to help discuss your options and what you can be doing there as well. Thank you so much for listening to another podcast episode of the CattleUSA Daily Podcast. We will see you all tomorrow on another episode. Have a good one, y'all.